How's it going? I'm Andrew with Investors Hub, and I'm super excited to have Paul Schatz back on the show. He's with Heritage Capital, and he's going to be talking to us about the state of the market and some sectors that he's paying attention to and some stocks as well. And he's also going to weigh in on JPOW and the FOMC and their recent press conference. So if you like the video, please be sure to like, comment, and subscribe. You can follow us on Twitter, ihub_vision. And after a quick disclaimer, we'll hear from Paul. Please note that our videos are not designed to be direct investing advice. Our channel and our content should just be one stop on the journey of trying to find out where to put your money. So, Paul, what were your takeaways from the last FOMC press conference and JPOW?
I've always been a pretty devout critic of the Fed, especially the Jay Powell Fed. I'll say this: it was boring, it was meaningless, we didn't learn anything. And those are probably the highlights of the meeting and the press conference. I guess the biggest news was that in their statement, they removed the words vaccine from the list of positives. There wasn't much to glean. Essentially what they have said and what everyone knows is at some point, they're going to start to think about the possibility of talking about cutting back on all the bond purchasing they're doing. 120 billion still. Someone a lot smarter than me will have to explain how they're doing $40 billion every single month in mortgage-backed securities with arguably the hottest, the white hot housing market. And it's not localized, it's nationwide. So I know people have said, well, the mortgage-backed purchases are not to support the housing market. Well, if they're not, what are they there for? We clearly don't need them. And we don't need to be buying $80 billion a month in treasuries. The economy is not in crisis. The markets, I mean, I couldn't even fathom someone trying to argue with me that the markets need more support and more help. Although it benefits me, certainly I've got my net worth invested in the markets, as do my clients, but this is not a healthy and functioning system when you've got this much intervention and almost manipulation. So I'd be super happy if sooner than later, and as early as next month at Jackson Hole, the Fed finally says, okay, here is what we're thinking about to be our plan.
So we recently got an announcement, it broke out on the news, that they're finally thinking about sort of maybe going to move forward on the infrastructure bill. Do you think that there's any chance that we get reasonable progress on that before they take a nap in August?
I'm going to go out on a limb and say that they're not going on August break. There won't be a recess in Congress without a deal done. It looks like they're oh so close. They've got a handful, maybe more than a handful of Republicans on both sides, and they're going to lose some Democrats, frankly. I do think Pelosi's going to blink. She's not going to have a choice. She's going to blink. There's not going to be a human capital side of this infrastructure bill, but it'll be good enough to get decent bipartisan support before they go on recess. They can go home to their constituents. They can all beat their chest, tell them how smart they am, tell her how great it's for the American people, blah, 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 blah. But I think one's getting done in the here and the now.
So are infrastructure plays still in the money, or do you think that hype and excitement for this infrastructure bill has already run those up past the point of buying?
Yes. So we know through rolling periods in the spring, certainly May and early June, the infrastructure plays, but really it was the reopening and economically sensitive, the cyclical plays. They, for the large part, the vast majority of them peaked. Like everything else in this market, they were super expensive, and nothing is cheap right now. You'd be hard pressed to find sectors that are cheap in the market. So you look at infrastructure ETFs like PAVE and PAVE and TOLZ and IFRA. They had nice runs. They're off their highs. I would say they're percolating. And I don't think this will be the sell the news. The sell the news was when we first thought the deal was done. So the ETFs, I think they'll probably perform in line with the market. There'll be relative performers in line with the S&P. It's not bad, it's not great, but those ETFs and those stocks got really bid up on the hopes and dreams and thoughts that infrastructure is going to get passed. You look at sectors like energy and materials and certainly industrials, kind of as bond yields rally, they rally, and bond yields came off, they came off. I have a very strong suspicion, I'll say I have decent conviction that we saw the bottom in bond yields. It'll be July this month. And bond yields, they don't have to soar again to get over 2%, but I don't think they're going to be falling like they have, which will then at least stabilize or give a tailwind to, again, materials, industrials, and energy.
So are materials, industrials, and energy the sectors that you're watching? Are there any other ones?
So we have I think our biggest position right now is in energy. We took a position in industrials this week on top of what we already have in transportation. I did fully liquidate our material position. So I'm still bullish on energy, I think, and kind of keeping with that infrastructure theme for a second. On the individual stock side, I have mentioned with you before, a laundry list of stocks I gave. VMC Vulcan was a big position we had months ago. And I think way back into some point in the middle of 2020, BHP Billiton, we just bought Kinder Morgan. Those are infrastructure plays that have done nothing, but they look like they're percolating. They look like they're getting interest again. I'll have a shorter leash this time around than I did a while ago. I think the worst case for those is they perform in line with the S&P 500, which again, it's not so bad. Getting back to stuff that's a little more timely, let's see. So this week and this month, we've been super active. As I said, we sold materials. We bought a new position in semiconductors, something I haven't had since, I think, April. I could be off on that a little bit. So we own semis now. We own transports. We took a new position in industrials. We used to have a very big position in the banking sector. That's slowly being cut thoughtfully towards what I think will eventually be zero. I wanted to buy more commodity ETFs during the pullback this month. I missed the boat. I wasn't nimble enough, and I'm not going to chase that because we've got such a large position in energy already. On the stock side, to be really granular with viewers, we did a lot this month, more so than we would normally do. So we bought Sprott, which is a play on people investing more in the gold and silver mining sector. Not that the sector has to go up, but that's more and more interest there. We bought Unum, the life insurance company. They've been on hard times. So all our buys have been more special situations. We bought, again, I mentioned Kinder Morgan, which is a play both on energy and on infrastructure. We bought Analog Devices, which is semis. We bought Parago. We bought BioMarine. Definitely idiosyncratic positions. I wanted to own more software. We've got a big software position already in Snowflake, in Mongo, in SPS Commerce. We bought Manhattan Associates, and then we bought Pan American Silver on kind of an indirect play for electronic vehicles and batteries. So that's for us. And I bought and sold KWeb all this week because it was plunged, and then I played it for a quick turnaround. And then we also sold a lot too. We sold our full position in the cannabis sector. We had ETF MJ, Skyworks we sold, Mohawk, the carpet manufacturer we sold, iHeartMedia we sold, Movado, and Caterpillar. So we've done, some would say, what's the overall theme of your portfolio? It's gotten a lot more diversified than it's been. I don't think it's going to be this red light, green light. Are we all growth? Are we all value? Are we all defensive? Are we all cyclical? I'm blending in more to give us a little more balance, frankly. And I'm okay with the added beta. I think we'll be okay. I think the market, you haven't asked me about that, but I'm going to offer it anyway. I think in January, I thought we'd see a summer peak. And from that summer peak, we'd see a 7 to 11% pullback. And I'm still of that mind. Price is the final arbiter. The market price-wise still looks strong, but underneath, it's not as strong as it was. You've got, small caps and mid caps, which are strong in the last couple of days, but they're not making new highs like the S&P, the NASDAQ, and the Dow. Participation has waned a little bit. So I still think there'll be a peak July or August, and we'll have a pullback into the fall. We'll reset for another run into Q1 of next year. A lot there to unpack.
So do you have any final thoughts? And where can people find your writing and content?
Final thoughts. Yeah, the bull market's not over. Every time we get the slightest pullback, and we haven't even had a 5% pullback since last October. So it's been a super nice run. Every time the stocks begin to roll over, people get so incredibly negative, like the bull market's ending. Bull market's only a year and a little bit old. Second years of bull market, you normally get a 10% decline. So bull market launched in 02, we had a 10% decline really in 03 and 04. Bull market launched in 09, we had a 10% decline in 2010. Bull market launched in 2020. 2021, we should get a 10% decline. There's nothing wrong with these, but the bull market isn't over. Investors should use 5 and 10% pullbacks as buying opportunities. Rotate into the things you love. If you don't love something you own, don't hold on to it. There's so much out there. Just don't chase nonsense higher. Don't chase IPOs, and don't chase things that are already up 100%, in a month, in a quarter. Be thoughtful about your investing. The bull market still has the ways to go. I write a blog every 3 days-ish a week, and you can find that on our website, investfortomorrow.com.
Hey, I appreciate you watching. And as always, if you hadn't already, please be sure to like, comment, and subscribe. It's the best thing you could do for our channel, and it doesn't cost you a dime. And I'll see you again soon.